Happy Hump Day, live from Studio 2 at Bloomberg headquarters in New York. I'm Scarlett Fu.
And I'm Alex Steele. It is Wednesday. Come on, guys, we can get there. We can get there to Friday. We are just about an hour away from the close. And let me tell you, it is quite a stellar rally that we're seeing in the equity market. We are almost to a round number. 5,000 doesn't really mean a lot, but it looks good and people like to talk about it. However, we are also very close to the median level of what analysts are looking at for the S&P for this year. So if we're already going to blow above that, do you have to re-rate your forecast for this year? How do you think about that? And you have, look at the triple Qs, right? Not the NDX, but honestly, both are at a record. Palo Alto Networks, you also have CrowdStrike, all of those techie names moving higher. And then the one that's really confusing is the New York Community Bank. It's now up by 5%, but man, you look at that intraday chart, and it is dicey. How are they going to finance? Deposits are staying, but they have a lot of problems, and they're trying to offload some loans from their books. And we'll talk about this in just a second. 10-year yield goes nowhere, but solid demand for that Treasury auction, Scarlett.
All right, well, commercial property concerns are really mounting, both at home and abroad. New York Community Bank, which you mentioned, is in talks to offload some of its mortgage risk, while KKR REIT slashes its dividend. And then over in Germany, a bank whose bonds slumped has responded by increasing its provisions because of what it says persistent weakness in real estate markets. Meantime, frenemies, anyone? Disney, Fox, and Warner Brothers Discovery are joining forces to put all their best live sports content online. This new sports streaming service is aimed at cord cutters who struggle to find their favorite teams' games online. It's also taken cable operators by surprise, sending shares of Charter Communications and Comcast lower. Leo Hendry, the co-founder of regional sports network Yes, will be joining us in the next hour to explain what's driving this unusual tie-up. But first, Alex, you mentioned the U.S. Treasury auction, the 10-year auction, biggest ever 10-year auction. It was a critical test for demand. What did we learn?
We learned that there's a lot of demand out there and that everything is actually okay. If we could update this chart, control room, to show the date for today, although it continues with the theme that we saw from last month. So as Scarlett was saying, this was a record amount of the 10-year auction, right? And you saw strong bid to cover. So bid to cover is a nice indicator of demand. That was nice and strong. The bottom panel is primary dealers who are taking down. They take it down when there's no other investors. Now, the primary dealership actually went down in this last auction. So you're looking at foreign investors, investment firms. See there? Investment firms all buying. So those are a really strong indicator. And then you get the 30-year tomorrow. We get $25 billion of 30-year bonds. And as Scarlett and I were talking about before we started the show, you saw a big gap higher in the S&P, but you still then saw the S&P to the highs of the session after this auction at 1 o'clock. So clearly the market enjoying this digestion, Scarlett. It was all right. It went well.
It went well, and we're seeing gains across equities, as you mentioned, getting close to that 5,000 level for the S&P 500. So let's kick things off here with Gargi Chaudhary. She is head of iShares investment strategy for the Americas over at BlackRock. Gargi, I want to get your take first on this 10-year auction, the biggest ever. There was some concern about investor demand after the big sell-off we saw at the end of last week and early this week. What did this test really indicate to us?
Sure. Great to be here, Scarlett. Thank you for having me. So I think what we learned today was that at the right level, at the right yield level, there will be demand. So just looking at the breakdown, and I know, Alex, we were just talking about it, looking at the direct takedown, actually, that was pretty encouraging to see that investors do have demand at these levels. And I think that, is it likely that we can see a little bit higher in yields? Maybe, especially if the data continues to be as strong. But the idea that clients are stepping in, pension funds are stepping in, households are stepping in to buy bonds, and we're seeing that in ETF flows all the time, I think that's really encouraging.
So what's also interesting is they're not selling stocks to do that. They're buying stocks and they're buying bonds. And I don't understand it. Like, what is happening? Why are we at 5,000 with the S&P? Like, why do we still get strong takedown for these auctions?
Okay, so a few things to think about. Of all the things that we learned this year, and it's only been a month.
It's only been 5 days.
Yeah. So number one, coming into this year, we had over $6 trillion in cash. So we know that, and that money had to go somewhere, and perhaps investors are feeling a little bit more comfortable about stepping out of cash because, and that's number two, because we have now learned that the next move from the Fed, whenever that comes, whether that be May or June, is going to be a cut. And we've got a lot of evidence that the economy, that's point number 3, the economy is really strong. Even when we look at Q1 GDP, that's tracking, that's moving higher. People are moving their estimates of Q1 GDP higher. So all of that, will, along with the fact that our research shows that when the Fed is on pause, which is now, is actually a really good time for both bonds and stock markets. So when you look at the fundamentals and then you look at the cash on the sidelines, I think that makes complete sense for markets to have a strong start.
Okay, when the Fed is on pause, I know that Jay Powell did not make any promises when it comes to ending QT or adjusting that, but when it does do that, is that still a Fed that's on pause, or is that something else?
You know, when and if, you know, they said that they're going to take a further look in the March meeting. We might hear a little bit more about the details when we look at the minutes. I think that there's 2 independent things. You have balance sheet policy on one side, and you have interest rate policy on the other. And they have told us for right now, we might find out more around QT and the tapering of QT, which at the margin will be more demand for at least treasuries.
Right, or loosen financial conditions.
Yeah, loosening financial conditions. And then on top of that, the next move will be a cut. And frankly, I think one of the things that the market has been very pleased with, and certainly the equity markets have been very pleased with, is the trajectory of PCE inflation. 6-month annualized at 1.8%, 3-month annualized at 1.5%, and earnings season, as we're learning right now, and earnings revisions, especially for the growth companies, continuing to move higher. BI stocks, my favorite screen on Bloomberg.
Thank you for the shout out.
I love this. Shameless plug for Bloomberg Intelligence. So it feels like the market has moved on from like when they're going to start cutting for the Fed and just how many cuts. And are we in a Goldilocks world where we have enough cuts to help the equity market, but not too many cuts that mean bad things for the economy?
So I think why they cut and how much they cut will be really important for equities.
Well, it seems like the market's saying like,
exactly. Right now, the 4 to 5 cuts that are priced in is viewed as cuts that help the economy while not signaling a recession. It's cuts that normalize, make sure that real rates are not restricted. These are normalized cuts. The minute we start pricing in 8 cuts or 7 cuts or something like that, I think there's something wrong. There's been some contagion, and perhaps equity markets, again, normalize a little bit, pull back. But I think pullbacks are healthy too. So a day like yesterday, and if we have a few more of a little bit of a pullback, I think that's totally fine given the last 3 months, 13 of the last 14 weeks, or even the 14 of the last 15 weeks that have been up.
So your theme for 2024 is that it will be the year of normalization. And you talked about normalizing a lot as you're explaining kind of why things are the way they are. What's going to be your big concern over the next couple of months as we continue on this path of normalization? What could trip that up?
So a few things that we'll be watching for certain. Number one, obviously, we're all looking at the concentration in the market, and the concentration does make sense when I look at earnings. The idea that quality companies are the ones that are having the most margin expansion, that are having the most sales growth, is what makes us favor quality. So to the extent that that continues to be 4 or 5 companies does get a little concerning. So we'll watch how that evolves and look for a little bit of normalization. So we actually like quality and large cap, but also like healthcare and financials as those laggards that might keep up. The other thing that I think we all have to watch is just any kind of reacceleration in inflation. That does not seem to be the case right now. But if that is something that we contend with in the middle of the year, that obviously brings back higher rates. And again, not the base case at all, but in terms of what we're watching, that could be something else. And then in the medium term, I'm always concerned around the debt dynamics of this country. So to the extent we continue to have fiscal worries later down this year, what does that mean for a yield curve, which I think is, again, a steepening of a yield curve, which is why we like intermediate duration fixed income.
Oh, the debt dynamics. None of us have any control over that. Gargi Chaudhary, thank you so much. Gargi is head of iShares investment strategy for the Americas over at BlackRock, looking for normalization through 2024. Now, coming up on the close, shares of New York Community Bank whipsawing on the day. The firm begins talks to offload a large part of its mortgage risk. NYCB is our stock of the hour.
Plus, cosmetic competition for the CEO of Elf Beauty joins us following the company's latest results. Investing in your face, this is definitely a thing. We're going to unveil its new ad for the Super Bowl as well.
And Disney releases its latest results after the closing bell. We've got breaking analysis as soon as they're out, including any news on its plans for a sports streaming service with Fox and Warner Brothers. I mean, teaming up with enemies. All that and more coming up. This is The Close.
One of the very fortunate things that I inherited when I showed up at Carlile is one of the best real estate investing teams in the world. Their performance over 20 years is truly extraordinary. When I talked to them about commercial real estate, they really started backing away from office many, many years ago. We don't see it as a sector where yet we see real opportunity. So I think there's going to be challenges, but I think this plays out over many, many years because in some respects, we can see this problem. But it's a problem that'll have to be digested by the markets over a number of years.
Yeah, let's get a little macro here because part of this problem is being caused on the heels of higher interest rates. And you have a market now that still expects more than 5 rate cuts before the January FOMC meeting of next year. Do you believe that those 5 rate cuts will come to fruition?
So we have a pretty unique perspective on this because across our portfolio companies, we have in excess of 1 million employees, and we see the data and the performance. I would say that if you step back and you think about historic Fed behavior, the Fed typically either is fine-tuning or cutting dramatically or raising dramatically. And when we look at the data from our portfolio companies, and then you look at strong GDP, unemployment numbers that are quite attractive, when you see inflation has really stopped materially and paused at this stage, I don't think we should be rooting for 5 or 8 rate cuts. I think that would suggest an environment that actually requires a lot of attention from the Fed. I think we should be hoping for fine-tuning because I think the economy is in better shape than people are giving credit for, and I think the Fed's done a fantastic job navigating this.
So what is a more realistic view of where rates go?
In our model, we would expect the base case to be 2 or 3 cuts. The Fed, we expect to be very data sensitive. We're watching this closely also. But again, my crystal ball may be as good as yours. So we'll see what happens. Markets are hard to predict.
What's the risk then that we tip over from a soft landing or even no landing into a recession? What would cause the tides to turn?
I think you could see if you had an unexpected market disruption, geopolitical event. But remember, the Fed has communicated to us that they're watching this data very carefully. And so hoping for multiple rate cuts I think is a little bit of a recency bias. I think it's people really saying, oh, I really enjoyed that QE that we were experiencing. I think as market participants, we should want a normalized cost of capital. And if we can get there through this process, I think it'd be an extraordinary outcome. And I think it'd actually be, great for business opportunities. I think it'd be really good for Carlile. And I think it'd be great for our investing clients. I think we'd create a lot of alpha.
That was Carlile CEO Harvey Schwartz speaking exclusively earlier today with Bloomberg's Shonali Basak. And Shonali joins us now from Washington. Shonali, first off, kudos on the interview. It was really great. Let's take a look at the stock performance. I'm looking at a comp chart of Carlile versus KKR and Blackstone on a normalized basis over the last year. Yep, Carlile got a pop. It has materially lagged. It is where they are now good enough to make up that lag?
It's a good question. You are seeing the share price react today significantly. It is having its best day since 2022. But to the point you're making, not only has the share price lagged, it has lagged materially. Last year, it rose about 36%. KKR rose more than 70% in that time frame. And listen, Ares, which was a much younger firm, was previously a smaller firm, the market cap is almost 2.5 times what you see at Carlile today. Now, we know that Carlile had a very significant transition here, succession as well as strategic changes. And this is really the first time we're hearing Harvey Schwartz, a year into his tenure, draw out those strategic visions. And what investors are saying today, they like what we're seeing, but there is a lot of competitive pressure in this industry. And Carlile is going to need to really invest to fight and compete in these areas next to Ares, next to KKR, because they're all competing in some of the same spaces, which is private credit and wealth in particular, big growth areas for these private investing giants.
You mentioned fighting to invest in these different areas and, of course, investing in its own people as well. Carlile making some changes to how it's paying its employees. Can you tell us a little bit more about that?
Yeah, there are a few things about this, and you have seen these moves come from the private investing giants. What Carlile is trying to do is make sure that the deal makers get more of that carry, which is really tied to performance and fee-related earnings going more back to investors. This is that recurring income. Now, a fascinating question, Scarlett, that came up on the conference call for Carlile was you heard an analyst really say to Carlile and its executives, listen, we like that you're giving money back to investors via buybacks, but when are you going to take that money and invest it more in the firm? And you had Carlyle's executives, Harvey Schwartz in particular, push back and say, listen, we are not going to compromise growth here. We are still going to invest. So to have that $1.4 billion share repurchase plan, of course, it's a big sweetener for investor. All of these firms are trying to become more shareholder friendly as they evolve, but they need to keep their deal teams incentivized. And after significant changes in the last year or so at private equity in Carlile, they are trying to keep the deal sweet for their deal makers, particularly as deals come back and potentially those performance fees.
Yeah, especially after a pretty dismal 2023 when it comes to deals. Shonali, thank you so much. Great job, Shonali Basak in Washington after her conversation with Harvey Schwartz of Carlile. Now, coming up on the close, proxy fights, streaming growth, and linear TV assets in limbo. Investors have a lot to digest when Disney reports its earnings after the closing bell. We're going to give you a preview of what to expect. This is The Close.
All right, time now for our top calls. We'll look at some of the big movers on the back of analyst recommendations. Let's go with Target. Upgrade to buy from hold by Gordon Haskett analyst Chuck Grom. Now, he says easing inflationary pressures and warmer weather may have people using their disposable income on discretionary items, which in turn could boost same-store sales. That stock up almost 2%. All right, next in line, Steve Madden, downgraded to neutral from buy at Citi. Price target, though, remains 41. The analyst is cautious about the company's profitability potential this year. Higher freight rates and promotional costs could be margin headwinds, just really limiting earnings upside for Steve Madden. Their shares down by about 4%. All right, finally, let's end on Fubo TV. So Roth MKM is slashing its price target to $2 with a neutral rating. And that sports streaming pack between Disney, Warner Brothers Discovery, and Fox could offer a more comprehensive range of channels, including those absent from Fubo TV. Shares down a whopping 22%. And those are some of our top calls. Now, speaking of, for the investors that were already seeking clarity about the growth and profitability of its current streaming lineup, Disney Plus, Hulu, ESPN Plus, that announcement of a sports bundle may alleviate some of that pressure, and it'll definitely be a huge point on the call today for Disney. Let's get a preview now with David Joyce, senior analyst covering sports and media entertainment at Seaport Research Partners. He has a buy rating on Disney's shares. No doubt, David, this sports streaming thing is going to be all over the call. Before we get to that, will streaming be profitable?
They are definitely working on it at Disney. I think year over year they will have cut their losses on the direct-to-consumer service more than in half. And I think they're on a trajectory to getting break even or better by the end of their fiscal year. So they're definitely doing the right things, and I think that's why you've seen the shares in Disney revive over the past few months. In addition to the strengths that they've been relying upon at the parks. But the streaming model, which the company has been trying to figure out with the rest of the industry, is definitely in an improving path.
Right. Okay. It's on an improving path, but it's something that's also attracted the attention of lots of activist investors. Bob Iger has to deal with Trian, Blackwell's Value Act. Is it possible for Bob Iger to appease all of them with blockbuster quarterly results, or is it more like whack-a-mole for him?
The thing is that so much has already been in the works and has already been contemplated and has been underway that these activists are all asking for. The streaming service joint venture that was announced last night with Warner Brothers Discovery and Fox has been in the works for 4 months. So I think that's a lot has been underway. You can't turn a super tanker so quickly. Things have been underway here, and I think that this new streaming service is one solution to make the content available to every consumer where they are. But that does mean that there are going to be some some potential losers if this is, the direction that the industry is going to be taking.
So, David, I guess I'm just wondering about the value proposition for the sports streaming. So it's going to be great. Okay, great. We're going to bundle that. But they have to charge less, significantly less, so someone will cut the cord and leave cable, but they still need to price it high enough to make money. And you think we're going to get a sense of what that sweet spot is, or in your models, what that sweet spot would be?
Well, this is something that was already discussed to a small degree this morning on Fox's earnings call. Fox is benefiting because they're contributing their networks that have been sports and news heavy into this this joint venture. But they say that they're going after the consumer who either have already cut the cord or have never been a pay TV subscriber, which could be a 50 to 60 million kind of subscriber market potentially. But these do happen to be the most expensive set of networks because they've had so much of the sports programming in their business model for so long. So if you were to parse it out, the Disney networks that are going in here, including ABC and all of the ESPNs, probably currently costs north of $12 per month or $15 in the pay TV bundle. The same with the Fox networks. They're also probably another $8. The Warner Brothers Discovery networks are probably another $15. So they're going to need to charge probably at least $40 just to attract subscribers. But again, there is a pretty big gulf between that and what the full cable bundle is.
Yeah.
Not at the not at an entry level price, but when you're at a regular price point. So it's not going to be it's not going to be an obvious move for some people, because if you're a true sports fan, if you go after this streaming service, you're still going to miss out on half of the NFL games that
Exactly.
are where the rights are held by Paramount, CBS, and Comcast, NBC. So it's not a complete replacement.
All right, David, thanks a lot. We appreciate it. We'll leave it there. We know you got to jump and check out earnings in about half an hour. David Joyce over at Seaport Research Partners. So this deal's not made for me. I don't do sports, but you do. And I can imagine it's very confusing. So if you have this bundle, you have other stuff over here. Amazon Prime has some things.
Still have to
like
pay for other
do you have
things.
like an Excel spreadsheet as to like what to watch, when, where, why, how?
Yeah, you could do that, but even then you have to consider, there's local blackouts. So, it gets very confusing. And I think a lot of people don't necessarily want to go to illegal streams, but they end up doing that because it's easier than figuring out how to get it legally.
Interesting. And also, I guess, wonder, there was a report out today that said $40 for the streaming. Is that the right number?
If you don't have
at some
a cable
point, just
package,
stay
maybe,
cable.
but it's
cable's
complicated.
$70 to begin with?
No, but with all the add-ons and the premium channels, it ends up being a couple hundred. And then you've got broadband. So no matter what, your cable bill will always come out to at least $150 to $180. You just can't escape it.
Yeah, but then you have the sports, you have Netflix, you have Prime, you have all these things. I wonder that they're going to wind up bundling streaming like they bundled cable.
Who says there's no inflation, or who says there's disinflation? Not when I look at my
Not in streaming,
packages.
that's for sure. All right, coming up, we're going to talk to the CEO of e.l.f. Beauty, getting his take on the cosmetic sector, invest in your face, plus the company's new Super Bowl ad. This is The Close on Bloomberg.
It's just about 3:30 in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Alex Steele. Okay, the whole commercial break, we were talking about investing in your face. Scarlett thinks that's funny. It was a luxury retail analyst that talked about how that's really going to drive some profitability for a lot of the high-end makeup.
What does that mean?
It means that you spend money on your face.
On good
Skincare
products.
items, on good products.
Okay.
I only shop on sale, and the only full price items I will spend on is face care.
Got it.
Invest in your
Invest
face.
in your face.
Speaking of, e.l.f. Beauty is out with its third quarter results. So it was really good, reporting net sales that grew by about 85%, marking the company's 20th consecutive quarter of growth. International net sales grew by 119%. The stock is down, though, about 3.3%, but honestly, it just hit a 52-week high. It had tremendous run, so keep that in mind. Tarang Amin is the CEO of e.l.f. Beauty. Tarang, great to get your perspective. I'm sure you're all about investing in your face. Where are you seeing the most market share grab right now?
Well, first of all, thank you for having me on. I'm really proud of the growth the company's delivered. And if you look at that growth, it's across every category we compete in. We have 16 categories where we're the number 1 or 2 position brand. We're now the number 3 brand nationally, the number 1 brand at Target. And we've seen strength across the board. And it's really great to see it. I'm very bullish on the category.
You mentioned Target. I want to ask you about shelf space. Any plans to expand e.l.f. Shelf space at Target, at Walmart, at Ulta, at Walgreens?
Yes, we announced during this call that we'll be expanding space at CVS, at Walmart, at Boots and Shoppers Drug Mart in Canada. So we've had a pretty good track record of consistently picking up space, and that's based on we're the most productive brand most retailers will carry on a dollar per foot basis, and really to them rewarding us with the performance that we've had.
So to that point, I was really struck by Estee Lauder, for example. Their quarter was disappointing. They had to lay off some workers also. Is it just that you're smaller, so you get to kind of grow faster? Is it a different kind of price point that you're targeting? Is it the fact that you can just do social media a little differently? What do you think is the factor there?
Well, I think there are 3 drivers of our business: our value proposition, our powerhouse innovation, and our marketing engine. If you look at our value proposition, our mission is to make the best of beauty accessible to every eye, lip, face, and skin concern. And we have this unique ability from an innovation standpoint to have these holy grails, products you previously could only find in prestige, where we take inspiration from our community and bring them to market at incredible values. One of the things I think you're showing right now is our lip oils. Our community came to us and said there was a prestige item at $40, but they couldn't afford it. So we created our e.l.f. lip oils at $8, and we get a lot of testimonials that it's even better than the prestige item. So I think that ability of having this extraordinary value with prestige level quality is what really propels our business.
I like the name of that, lip oils. I've just learned, Alex, about something called Ozempic face. Do you know what that is?
Yes, but you can tell me.
Okay, it is a hollowed out, kind of saggy look that some patients report after taking weight loss drugs. And not pretty. AbbVie, which makes Botox, actually sees Ozempic face as a positive catalyst. Doreen, does Ozempic face create a tailwind for e.l.f. for cosmetics as well?
Well, I think there's a tailwind overall. I think particularly after the pandemic, there's so much pent-up demand of being able to go out and express yourself and being able to have, particularly for us, where we have strength not only in color cosmetics, but also skincare. We have 2 of the fastest growing brands in skincare with e.l.f. Skin, which was up 89% in the quarter relative to a category that was up 9%. And Naturium, a clinically effective, biocompatible skincare brand that's also one of the fastest growing brands. So I think that strength in our portfolio and the white space we have in front of us allows us to take advantage of any trend.
So, Scarlett, I actually asked the CEO of Novo Nordisk, because he was in the headquarters here, and I joked about it, but I was serious. I was like, does this happen? Is this what you're talking to? And he said that some unnamed food retailers will call him and be like, what will the impact be? He hasn't gotten any Botox providers or makeup providers as of yet, so he said, but that idea is that this could be enormously disruptive.
Interesting. Do any CEOs of food companies try and contact you about what this might look like? How cosmetics might fold in with the Ozempic trend?
No one's reached out to me yet, but we'll be happy to talk to anyone.
Got it.
But in terms of where you sell stuff, I have to say, I'm buying more and more makeup on Instagram, which is, if you know me at all, a weird statement to say. How important a strategy is that for you? Because the higher end brands can't really compete on that level.
Yeah. Well, we're a digitally native brand. We were founded 20 years ago selling cosmetics over the internet for $1. This is before the iPhone, so a definite pioneer in terms of online shopping. Our digital business in the quarter was up over 100%, and we have strength on elfcosmetics.com, our own site, which is propelled by our Beauty Squad loyalty program, but also at Amazon. We were also the beta on TikTok Shop. And we see that with our strength in social, the immediacy of that purchase really makes a lot of sense for us. So we continue to see real strength, not only in our digital business, but also in our national retailers and international. So we really are able to capitalize on being that digitally native brand that is a pioneer on key frontiers.
Okay, digitally native brand, but still, how can you pass up an opportunity to advertise at the biggest show on earth, which will be the Super Bowl on Sunday? Tell us about your plans and what viewers can expect to see.
Sure. So while most of our efforts are digitally oriented, last year we had an insight that the Super Bowl draws a huge audience, and over almost half the viewers are women, yet no one was really serving them. So last year we partnered with Jennifer Coolidge and featured our Power Grip Primer, the #1 item in color cosmetics, and we saw over 60 billion impressions. So this year, as you're seeing, we partnered with Judge Judy and the cast of Suits, and really dramatized that you don't have to overpay for makeup. I think she ended up sentencing one of the cast members with $14 Halo Glow liquid filter, which allows you to have that glowy, beautiful face at a fraction of the cost of Prestige. So I think we're going to have some real fun with this.
Tarang Amin, CEO of e.l.f. Beauty, thank you so much. Looking forward to that ad. And of course, you talk about the cast of Suits, and I'm thinking, where's Meghan Markle in all this?
Yeah, but true. But also, Suits like super hot on Netflix.
Yes, yes.
So I mean, I can see the parallel there.
I know it worked out pretty well, didn't it?
Yeah.
All right. Well, are
Face.
you going to watch the Super Bowl, by the way, even for the ads? For the ads.
I feel like I have to.
Yeah. You work here.
My friend's having like an anti-Super Bowl party, though, sort of like a Chinese New Year party instead. So I feel like I need to do that.
The two will collide, I have a feeling.
Chicken wings and noodles.
Yes, absolutely.
All right, fine.
All right, coming up, let's talk about shares of New York Community Bank. They're all over the place today. Moody's cut its credit rating, and of course, they're making moves to kind of reduce their mortgage risk as well. It is our stock of the hour, and it's up next. This is The Close.
I do have a concern about commercial real estate. I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
The U.S. Treasury Secretary there, Janet Yellen, weighing in on the commercial real estate market. And one of the firms feeling the stress that she referenced is New York Community Bank. The shares all over the place today, down as much as 14%, up as much as 9.5%, currently now down about 7, or I should say up about 7%, see? Following a multi-day rout, as well as a Moody's credit downgrade to junk. NYCB is our stock of the hour, and here with us now is Sally Bakewell, who leads our U.S. finance coverage. I'm not going to ask you to make sense of the stock move because it's been everywhere, but what is happening today that has everyone's attention?
Thank you for not asking me to make sense of that stock move. Well, I think we did have a few developments today. First and foremost, we heard from management for the first time since the sort of a big announcement last week where it's cut its dividend and had to sort of shore up reserves against commercial real estate losses to a much bigger magnitude than anyone expected. Now, there were sort of three big takeaways from this call, which was somewhat hastily arranged, they acknowledged. The first one is that the management is prepared to do whatever it takes in order to ensure that the bank has enough capital, whether that be asset sales, which Bloomberg also reported some of today, whether that be a capital raise or whether that be just shrinking overall. They also said they plan to shrink their commercial real estate exposure and concentration because obviously that's been at the heart of some of its problems. And then lastly, they really made efforts to assure on their deposit levels. And they said that they had seen virtually no withdrawals of deposits from their retail branches, which is important because that, if they had, that would make it more of a liquidity issue, which is what we saw with the regional banking turmoil last year. So far, it doesn't look like it is that kind of issue, but indeed the market didn't seem to love the call because the stock continued to tumble during and after it. Perhaps they were still reeling from the 70% dividend cut. Perhaps they wanted more tangibles and more numbers. But either way, yes, it is back up again now.
So going to selling some of their mortgage loans, they also talked about their RV loans, which I thought at some point was like a cool name for a type of loan. I was like, oh no, literally there's RV loans. Is anyone going to buy those loans? I'm curious as to what that bid-ask spread looks like now versus, say, a week and a half ago.
Right. I think there will definitely be, this is where private equity will swoop in. It is probably...
Right, this is what they've been waiting for, right? To buy all this stuff real cheap.
Exactly. This is their big moment. This is their opportunity. We know that they are waiting in the wings. We know that there are calls going on. They're making inquiries. And that's exactly what they did in the turmoil last year. So I think there's no question that they will be circling for these assets, not just from New York Community Bank, but from other banks that have already been and will also be trying to sell assets to make sure they can shore up capital against future commercial real estate losses.
Once you start to sell something, there's price discovery and perhaps other transactions will follow. If commercial real estate concerns really start bubbling up again, are big banks like JP Morgan, for instance, seen as the unequivocal winners once again?
they do not have the sort of same magnitude of problem here. Their exposure is much, much less than their regional bank counterparts who, regional banks, they're tied to the community. They have relationships with property developers. So their commercial real estate exposure is just by its very nature higher. Whereas bigger banks are much more diversified. They have other business lines to rely on. So they are not really seeing this problem. It really is the sort of tier of banks that fall, in the slightly smaller regional size. And there's an interesting sort of regulatory angle to this situation too. New York Community Bank, it was the acquirer of some of the failed Signature Bank's assets last year, if you remember. And there's a sort of somewhat of an irony there that it is now here trying to sell assets to raise money itself. But that move tipped it into a new regulatory capital of above 100 billion in assets. And that means it has to shore up more capital to meet those requirements, which prompted it to do some of these actions. So it's been a very sort of confusing regulatory situation here too, which I think investors are trying to get their heads around.
If, though, you have the government like the Fed having to step in to stem these losses, is there going to be another New York Community Bank that's going to buy the stuff from New York Community Bank like they did from SVB?
Well, so far, I think, this problem has been going on for a couple of years. Banks are well prepared and actually should be very well aware of the situation. And we've seen a lot of banks take reserves against commercial real estate losses. And if we hadn't had this big New York Community Bank news, they would probably be doing that largely unnoticed, and particularly, against US commercial real estate. But because we had this big sort of shocking announcement, suddenly all of those pressure points seem much more sort of exaggerated than they perhaps are. And it is indeed a problem because prices have declined. And of course, the trajectory of interest rates is also a factor. Yeah. But banks have been well aware of this for a long time.
Yeah. All right, Sally, thanks a lot. Really appreciate it. Bloomberg's Sally Bakewell. We were talking about this on radio. At what point does Jamie Dimon get that call?
Jamie Dimon gets a call all the time. I think it's safe to say.
But, at some point,
Jamie,
it's going to be like, hey, no, we need a little bit more help here. Remember all that First Republic stuff. Anyway, coming up, you got a fresh slate of earnings out after the bell. Let's name a lot. Disney, Wynn, Mattel, Spirit Airlines. That's just 4. Insight on what investors should be watching for with Ed Clissold, Chief U.S. Strategist at Ned Davis. This is Bloomberg.
This is the countdown to the close. I'm Scarlett Fu alongside Alex Steele. And Alex, we have a rally on our hands, and I know you're puzzled by this. You've been puzzled by the rally all year, but today in particular.
I know. We're like kissing that 5,000 level. And again, my question is, if your median look for the S&P for this year, we're already at that level, do you have to revise stuff up? Like 5,100, 5,200 is not insane, and that's some of the most bullish calls that we're going to see for the S&P. The NASDAQ 100, triple Qs, they're all at a record. You have some of the poppier stock, like Enphase Energy, that's an earnings story, it's a solar story, they may be in the trough, that's the biggest leader within the S&P, and then a stock that I can't see because I can't see.
New York Community Bank.
Oh, you're the best. New York Community Bank, we were just talking about that, and I just think it's worth hitting yet again because of the volatility that we've seen in the stock today. I wish I could show you. We've seen the intraday chart is unreal.
Yeah, it's all over the place. It's been down as much as 9%, up as much as 14.5%, currently up, and we're still kind of scratching our heads trying to figure out what's driving all of that. All right, there's also, on top of that, Fed speak, with officials saying that they don't see an urgent case for lowering interest rates yet.
At some point, the continued cooling of inflation and labor markets may make it appropriate to reduce the target range for the federal funds rate. On the other hand, if progress on disinflation for some reason stalls, it may be appropriate to hold the target range steady.
Expecting all indicators to be well aligned is too high a bar. But seeing sustained, broadening signs of progress should provide the necessary confidence that I would need to begin a methodical adjustment to our policy stance.
I'm very supportive of being patient, to get to where we need to get. I see at this point the trade-off, which is, coming into better balance, is still being in favor of continuing to work on inflation.
All right, let's welcome Ed Clissold, Chief U.S. Strategist over at Ned Davis Research. And Ed, no matter which Fed official is speaking these days, it sounds like they've settled on a pretty consistent message, which is they can afford to wait, they can afford to be patient, to wait for more data showing inflation heading towards that 2% level, a sustainable level, before they move forward with any interest rate cuts. That being the case, why are equities continuing to climb higher with the S&P 500 pushing towards 5,000?
I think overall, this is a good message. If the Fed can wait and move slowly with their rate cut cycle because the economy is doing well, that's great for earnings. In fact, if you look back historically, when the Fed has had to move very quickly, that is over five or more cuts in a year, that's actually been negative for stocks. When the Fed's been able to cut fewer times than that, and actually the S&P's up on average 24% 1 year later. So not necessarily saying we're going to get that this cycle, but it does tell you the message of the Fed being able to ease because inflation's coming down, the economy's doing okay. That's an overall positive message.
All right, Ed, so let's just say I'm in some money market funds. I want to do something more with it because that rate has come down. I don't want to sell stocks, but can I buy stocks?
Well, I think this is where the paradox of where we're going to focus within equities comes into play, where growth is good. It's not gangbusters. So we're going to gravitate to those companies that are going to give us a really strong growth. And that's why you're seeing, number one, companies that have really strong numbers this earnings season, they're knocking it out of the park. But also, there's been a lot of companies that have beaten. We're over 80% beat rate for the S&P 500. We're about halfway through earnings season, so there's some more to go. But that's a pretty high percentage. In fact, this is the first year, we go all through all 4 quarters of 2023, where the beat rate has been 79% or higher. So this is overall is a good message for earnings and therefore the market.
You talked about how the overall message on the economy from the Fed is good, and that's enough to support equity prices moving higher, maybe not at a gangbuster pace, but certainly kind of levitating higher. Once we do get a rate cut, whether it's in May, whether it's later on, what is the market likely to do? What has history shown us tends to happen?
Yeah, so on average, the market's done pretty well, up 14, 15% 1 year later. But a lot of times historically, so we're talking about going back like 80, 90, 100 years, the Fed used to be very reactive. So they would wait until you're already in a recession and probably the market was down a lot. So the market was probably going to rally anyway, and the Fed cuts were kind of an extra kicker. More recently, the Fed's been more proactive. And so you have, looking at the last 7 times the Fed's cut rates, 3 of the times it didn't matter, like in 2019, 2007, 2001, economy went to recession anyway, and you're down about 5% 1 year later. But the previous times, like in 84, 98, the economy did well, and the market was, again, up over 20% 1 year later. So we're kind of boom or bust. Either the Fed is achieving the soft landing, the market should do really well, or they've waited too long. And our base case is that the Fed's on pace to achieve that soft landing. So overall message positive.
So what's up with small caps then? Like, why haven't small caps, and we can't even make it a big tech story, because if you do the S&P equal weighted versus small caps are still underperforming. And the scenario you're laying out, it feels like you want to go buy small caps.
Yeah, and I think a little perspective here, and it is because it's a great question. Small caps had a huge run toward the end of last year in anticipation of these rate cuts. The market got ahead of the Fed, expecting these 6 rate cuts, maybe starting in March. And so we're pricing that out. And we would expect that once we get closer, maybe that's when small caps could have a lift. The other thing is that if you look at the area of the market that's probably most sensitive to when the Fed cuts, are the regional banks, and they really populate the small cap value area, and so that's really where you're seeing the weakness. But so maybe that now is not quite the time, but as we get closer to the Fed cuts, maybe that's the area that can play catch up.
Yeah, we've seen how value can stay value for a long time and longer than anyone expected. Ned, Ed of Ned Davis. Ed, what does your data and what does your surveys tell you about sentiment right now? Because we talk about the S&P 500 approaching 5,000. People cite this wall of worry, but there's a lot of optimism out there, isn't there?
It is. So we have a sentiment composite that has 7 different indicators in there, things that most people see, polls of individual investors, put-call ratios. It's been what we call the excessive optimism zone for over 50 calendar days, or trading days, in a row. That's the 10th longest streak ever. So this has been around for a while. You can stay there for even longer, but once you kind of come back and sentiment rolls over, the market tends to be pretty weak for about 3 months. I say pretty weak, basically flat. And so that could be part of the message here, where we've had a nice run, maybe we consolidate the gains. Now, if we were to stay in this optimism zone for even longer, like over 100 days, that's when it gets even trickier, because that's when a little bit of froth becomes more bubble-like and blow-off top type of behavior. So it's almost better if we take the froth off now than keep going for a couple more months.
Yeah, so sell-offs or drawbacks are healthy in the long scheme of things. Ed, thank you so much for joining us today. Ed Clissold is Chief U.S. Strategist over at Ned Davis Research. All right, we are moving closer to the closing bell. Full market coverage coming up right now as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We're about 2 minutes away from the end of the trading day and a slew of earnings. Scarlett Fu and Alex Steele here. We're counting you down to the closing bell, and here to take you beyond the bell with a global simulcast, Carol Massar and Tim Stenovic. Of course, welcome to Bloomberg Television, Bloomberg Radio, and our YouTube audiences who are joining us via the stream as we parse through the most crucial moments of the trading day, but really look ahead to the earnings that are coming out soon.
Yeah, I'm kind of trying to figure out where do I focus, and I've got my NI earnings function already up on the Bloomberg. Having said that, it was an interesting day, that record 10-year auction, an important one, maybe giving us some indications about kind of ultimately what bond investors, where they think bonds settle. So that, here I'm looking at a 10-year with 4.11. So I think these kind of data points are really important as we try to figure out maybe where the Fed ultimately lands on monetary policy.
Okay, you're looking macro, I'm looking micro. I can't look away from these cable companies after yesterday's news, Alex, about the Hulu of sports. This was really interesting. Walt Disney, Fox, and Warner Brothers Discovery all teaming up. As a result, you're seeing cable companies really take a hit today. Shares of Charter are lower on the day. Comcast is down 3.5% right now. Geeta Ranganathan over at BI saying this could be the end of the pay TV bundle.
I mean, big call from her. Okay, you guys are looking at macro, micro. I'm looking at volume, because volume is just really pitiful in the equity markets. And again, it just raises more questions than answers to me about whether this kind of rally is sustainable. Can we really, what does it mean when we get to 5,000? Who's going to be piling in at this point? And can you do it if the volume is weak? And can you do it if you don't have that broadening out, like I was mentioning in small caps? But usually when I say something like that, it's the opposite. So the answer to that would be yes. It can still continue to rally.
I'm kind of bearish, too.
Thank you.
But you assume that we're going to get to 5,000 easily. I don't know about that. As you get closer to 5,000, everyone kind of backs off.
True.
And it takes like a couple of days, maybe even a couple of weeks to actually get to that round number. All right, let's take you through the closing numbers right now after the closing bell is rung. You have the S&P 500 about 5 points shy of that 5,000 level, up 0.8%. So a pretty broad advance, at least from a percentage basis. The Dow Industrials gaining 0.4%, and the NASDAQ, the best performer on the day, almost up by 1%.
All right, on that kind of weak volume, S&P 500, guys, 310 names to the upside in the trade, 189 to the downside, and 4 unchanged. Scarlett.
All right, actually pretty broad rally when you look at the sector performers, too. Let's take a look at the IMAP. Lots and lots of green. Infotech, consumer discretionary, communication services, the biggest sectors within the market, rising the most. Real estate investment trusts and consumer staples are your weak points, but at this point, they're a little changed.
All right, well, we got some earnings coming in. Let's look at shares of ARM. They're moving higher in the after hours right now. And looking at why, about up 1.2%. The company receives fiscal year adjusted earnings per share of $1.20 to $1.24, saw $1 to $1.10, so coming in above estimates there. Estimates were for $1.05. Third quarter chips reported as shipped, 7.7 billion. Third quarter total revenue, $824 million, beating estimates of $760 million.
Yeah, that was pretty solid from ARM. And again, we have a slew coming out too, waiting for Disney. That's going to be the big one. I'm looking at PayPal. I'm looking at Mattel. And you guys were also talking about sort of the other movers, right? And that also has to be in the bond market, Carol. You were mentioning that we digested that really well, in which case that was a good relief for investors. Maybe that helped contributed to that move higher in the equity market also.
Yeah, absolutely. I just want to go back, if I may, to ARM Holdings, because we're seeing this one up, about 10% here in the aftermarket. So 16% to the upside, right? The semiconductor sector, we watch it in all of its iterations, if you will, but to see that outperformance, again, that fiscal year adjusted EPS, $1.20 to $1.24. It had seen $1 to $1.10. The estimate was 105. So that is a pretty upbeat outlook, to say the least.
You know, when you have these chip makers, there's been a bifurcation, right? The chip makers that rely on industrial customers customers like automakers. They've seen some struggles in the fourth quarter numbers, but anyone that's tied in any tangential way to AI seems to do really well. And those that are, of course, dependent on the smartphone market seem to be holding up as well.
Okay, so shares of ARM up about 11% in the after hours. We're also seeing shares of Wynn Resorts move higher by about 2.9% right now. The company's fourth quarter operating revenue coming in above estimates, $1.84 billion. Estimates were for $1.74 billion. The company's adjusted EPS, let's look at the bottom line, comes in as a big beat. Estimates were for $1.16, coming in at $1.91 per share, Alex.
Yep, that's a 5-star hospitality. That's basically what they're saying. Got strong momentum because they're 5-star hospitality. They also talk about Las Vegas, Boston, and Macau, kind of pointing out some strong points there. But man, nothing like ARM.
Let's go back to it. It was jumping up about 16%, still up about 13% in the aftermarket. You guys might remember that just over the last week or so, our own Ian King coming out and with a story about the global chip industry poised to bounce back after a tough 2023. So the industry overall projecting 13% rise in sales. But again, boosting the full year profit outlook is ARM. Again, go back to the number for fiscal year adjusted EPS. So it's looking at the full year, feeling confident. Here we are on February 7th to say we're going to see EPS of $1.20 to $1.24. That is significantly above its earlier estimate of $1 to $1.10 and above the street estimate of $1.05.
You know, once upon a time, ARM was kind of just a way to look at what's going on with Apple because it was such a key supplier to Apple, but it's really pushed beyond that and trying to serve other markets, including server chips. So it's a bigger, broader read on the overall supply chain.
Apparently, it also licenses basically the fundamental set of instructions that software then uses to communicate with chips, which is why it makes it so different and has a different role in the semi industry and doesn't necessarily have just sole exposure when it comes to the smartphone market, Tim.
To that point, Alex and Scarlett, there's a lot of great information in the shareholder letter here, which I think is a kind of a unique thing to say when it comes to these companies reporting quarterly. The company said that ARM continues to gain market share in the growth markets of cloud, servers, and automotive, which drive new streams of royalty growth. And then the broader semiconductor market is showing signs of recovery. We're hearing that over and over again from these chip companies, particularly in smartphones, which returned to a strong growth in the third quarter. Licensing revenue supported by increased demand for new tech driven by all things AI.
Yeah, it's really significant, right? This is such a kind of potentially an early indicator. If they are feeling confident in terms of their outlook, you know, it makes you think about kind of all of the folks that are their customers, whether it's, I'm looking at ARM Holdings, you know, you've got Advanced Micro, you've got all of the big chip players that basically tap into them. All right, folks, let's go to Disney and let's get right to it because that first quarter Disney Plus subscriber number, they are looking at 149.6 million is the number. The estimate, that's a little bit shy, 151.2 million. The company, though, boosting its cash dividend 50%, targeting a $3 billion buyback in fiscal year 2024, sees fiscal year adjusted EPS of about $4.60. That's way above the street target of $4.27. But nonetheless, it looks like they're maybe giving that dividend to make potentially appease some of the investors that are out there because this stock has certainly been under a lot of pressure from activists and others.
And it's under a bit of pressure right now. What's interesting here in these results is that you look at the bottom line, big beats. First quarter adjusted EPS $1.22. Analysts were looking for $1.02. Entertainment operating income $874 million. Analysts were looking for about $600 million. Total segment operating income $3.88 billion. Analysts were looking for $3.3 billion. So a beat on the bottom line. But when you look at the top line, entertainment revenue, overall revenue, even Disney Plus subscribers, those come in less than expected. So is this all on the back of cost cuts? It looks like it.
I mean, the subscriber number is not great, right? I mean, 149.6 million might be great, but like in comparison to estimates, isn't that sort of a worry? Like, how does that then help profitability?
This is where we need to get some insight on ARPU. We were talking to Geeta Ranganathan, so basically average revenue per user. She said the streaming profitability is really key, but she said they were probably going to lose some subscribers because of some of the price hikes. So this is where we need to see if it is a little bit more profitable ultimately on the subscribers they have, even if the base is reduced. So
right, if some people leave, but
insight.
the ones who stay are paying more, then the average revenue per user should go up. We should note revenue was little changed, but did fall short of the $23.8 billion average of estimates compiled by Bloomberg. Disney's been struggling with its TV business and two theatrical misses, The Marvels and Wish.
Yeah, experiences revenue, $9.13 billion. Analysts were looking for about $9.04 billion. Experiences should include the parks division, which of course has been doing very well, but it faces some pretty tough comparisons because last year was the 50th anniversary of Walt Disney World. It's not going to get that kind of reception once again. So that's going to be a big part of the picture here as we look at everything. Is this going to be enough to appease all those different activist investors who are, banging on Bob Iger's
cash dividend being increased by 50% and $3 billion worth of buybacks over this year, maybe?
All right, so a little bit more in terms of the release. The company expects to add as many as 6 million core Disney Plus subscribers this period, continues to predict its streaming operation will reach profitability by the fourth quarter of the current fiscal year. We're not quite yet. We were looking to see if they would do it this year, but not this year, but this quarter. So nonetheless, we continue to see, kind of waiting for that profitability metric. I'm just kind of trying to pull up. Disney's now up about 4.7% here in the aftermarket. So I feel like there's a lot of moving parts, but maybe there's enough for investors to see that maybe they are on the right path, especially when it comes to streaming profitability.
One thing that's worth noting is Bob Iger tends to have this habit of including good news or giving some kind of good announcement during the earnings release.
It is the Magic Kingdom, Scarlett.
Exactly, right? He delivers magic. So the earnings call will be critical here.
Yeah, and also about the new, sports tie-up, if you will, in terms of how that plays into it. What does it mean for ESPN, which they supposedly, are trying to get rid of? So, all right, we got to run. Disney shares now up about 6%, guys. All right, that's a wrap. Our cross-platform radio, TV, YouTube, and on Bloomberg Originals. We will see you again tomorrow.
All right, we are not done with Disney yet. Let's bring in Geetha Ranganathan. Carol mentioned her. She is Bloomberg Intelligence's media analyst. Geetha, you've been looking at these numbers here. What accounts for the profit beat, but the revenue miss on some of the businesses? Is this cost-cutting delivering the bottom line numbers here for Disney?
It definitely is. I mean, we're seeing that. I think the first number that I was really looking at, Scarlett, was the streaming profitability number. That is done much, much better than what we were kind of expecting. So we were expecting about 400 million in losses. They came in way below 138 million in losses, which really shows that the streaming profitability or profitability in the streaming business is really on track. Of course, they're saying that they're going to hit profitability in 4Q, but I think they definitely are making a lot of progress with the cost cutting, with kind of that whole content rationalization. And we're seeing that actually across the board. I mean, as you just pointed out, across the board, we saw them beat on their operating income metrics.
Mm-hmm. Yes, we did. The subscriber, though, for Disney Plus coming in a little lighter than estimates. We don't care about that as long as the profitability metric is there.
Yeah, we kind of expected this. So they raised prices for Disney Plus by about 30% in October. And so they were kind of expecting some churn. And also remember, there wasn't really much of a big content slate kind of in the last quarter. And it's going to be pretty light on the content front for the next few months as well. That said, they are expecting kind of this reversal in subscriber growth. So they're pointing to about 5.5, 6 million subscriber gains this quarter, which is, again, slightly above what the street was expecting. So I think that's definitely good news. Remember, this is now a balance between, subscriber growth and profitability. And as long as they can show that they're able to do both and do both well, I think investors will definitely cheer.
Well, investors are definitely cheering the return of cash to them, right? Because Disney has boosted its cash dividend by 50%, also says it's targeting a $3 billion buyback for the fiscal year of 2024. I mean, when you start returning that kind of cash to shareholders in a company that's still kind of in turnaround mode, it's saying, stay with us, be patient, we'll deliver for you eventually. What does Bob Iger need to buy time for?
Well, he still has a lot of things that, need a lot of rejiggering, right? And I think the one biggest thing that has kind of vexed investors has really been the content strategy. We've seen a lot of misses on the theatrical front, a lot of their content titles not performing as well as, some of us would have hoped. So that's something that they definitely need to address. And then, of course, I think the end game with ESPN. I mean, I think yesterday's announcement was definitely a good first step. But I think ultimately we still kind of need to wrap our arms around what they're planning to do with that asset, whether, they're going to spin it off, or what exactly is going to happen there.
Yeah, it raises a lot more questions than provides answers. Geetha, thank you so much. U.S. media analyst for Bloomberg Intelligence. Geetha Ranganathan, one of the best in the business, and we are lucky to have her with us. All right, coming up, we're going to take a deeper dive into those Disney results. But first, we want to pose a question to you. Which Disney classic, Alex, premiered on this date in 1940?
I know.
All right, well, we'll give you all the answer when we come back. Alex knows, but we'll let you in soon. This is The Close on Bloomberg. This is The Close. Well, today Disney sets the standard on the entertainment powerhouse and everything from theme parks and cruises to Broadway shows. But it owes all its early success to animation. And as founder Walt Disney famously said, it all started with a mouse, which does bring us to today's question: which Disney classic premiered on this date in 1940? And the answer is Pinocchio. Adapted from a novel by Carlo Collodi, it tells the story of a wooden puppet made by a man named Geppetto and brought to life by the Blue Fairy after Geppetto wishes he could have a son. 82 years later, in 2022, there was a live-action remake that premiered on Disney Plus to mostly negative reviews. Disney has struggled to find profit in its pivot to streaming, leading investors to question whether the company is able to recapture that early magic. Alex?
All right, actually, I thought it was going to be Snow White, but now that I think about it, I recognize it was Pinocchio. But that remake was amazing. Anyway, let's stick with streaming. Want to focus on the plan Disney, Fox, Warner Brothers to launch a sports-focused streaming service. I should point out that stock is now popping 7%, while Disney also announcing a $1.5 billion equity stake in Fortnite maker Epic Games, all part of a collaboration involving Disney properties like Star Wars and Avatar into gaming. So that's definitely a good headline to watch as well. Joining us now for the sports side, Leo Hendry Jr., former president of TCI when it was the world's largest cable TV operator. He was later president and CEO of AT&T Broadband. Leo, it's so great to talk to you about this. So many things to go through, but you're one of the perfect people to talk to about basically the Hulu for sports. Is Disney doing the right thing?
Well, I'll try not to lie to you like Pinocchio. Today is one of those days that will be remembered for a decade, literally. It was impactful at every angle. For 40 years, we in the cable industry lived in the bundle. And we lived in the bundle as sports prices rose every quarter, every year. And today is one of those days that'll be remembered for finally busting the bundle. We used to have as many as 100 million households in the bundle. It's today 55 million. And what's happened today with the announcement about ESPN, Fox, and Warner Brothers Discovery is you're trying to slice the sports product completely out of the cable industry and hold it for yourself. And you have to ask the question: what happened today to Paramount? What happened to NBC? Yes. They were left out. They can't take that lightly. There'll be RSNs had the worst day in their history. They will be eaten alive by this announcement. And you're going to have to find out if the government will allow it to happen. You'll go to both the FCC and to the Justice Department and ask what they think.
It could get very messy legally when it comes to the RSNs, the regional sports networks, including Yes Network, which you co-founded. I wonder, though, how much of this is a defensive posture? Is this a tacit admission from the likes of Fox, from Disney, from Warner Brothers Discovery, that live sports rights, live NFL rights, NBA rights, are too rich for these companies, even as they're the ones bidding them higher?
Well, I think, Scarlett, as usual, I think you hit it on the head. Sports is just absurdly expensive right now. And so you're trying to move it up from the bottom into streaming product, but it's expensive. $40 is a suggested monthly price for this product called Winner. It may be in their eyes today, Scarlett, a winner. It's certainly not a winner in the eye of Paramount, NBC, RSNs, affiliate stations in your local market. RSNs, as I said, all of them have been put under an uncertain umbrella for the next, really, I suspect, as much as 10 years.
So does that mean Paramount and Comcast will need to team up CBS and NBC sports rights? Do you see that as a possible response here to this three-way live sports streaming product?
In their own way, all five companies are telling you quietly, but telling you in some conviction, we can't afford these rights as they are today. They're ever rising. Our customers are leaving us. I think $40 a month for that streaming service is a breathtaking price. You have your entertainment streamers next to it across the board. You have 10 entertainment streamers. You have this announcement today of a new streamer, sports only. I think the disruption up and down the food chain is going to be acute. And again, I would bet against the RSNs today. I think they've been dealt a hard blow. And you really do, I think, as usual, Scarlett, you're on the point. You really do have to figure out what you do if you're Paramount or NBC.
Well, what do you do? Leo, is this good for the food chain of sports, like the NBA, sports teams? Is this good for them?
Well, the commissioners, Goodell and Adam Silver at NBA, have read the article 14 times in the Wall Street Journal to figure out what's happening.
Fair enough.
Who should own these rights? Should the leagues own these rights? Should this intermediary in the middle called Winner at $40 a month, should it substantially own the rights? The one thing we now learned is nobody at the affiliate level or at the RSN level is going to end up owning these rights in a material sense. Yeah. It's going to be a war fought between the Big Five and the leagues, NHL, NBA, and certainly NFL. MLB as well.
I don't know. I still don't get like where you can get a basic game anymore with all this. It's just way too confusing. Hey, Leo, thanks a lot. It's really wonderful to see you. Leo Hendry Jr., former president and CEO of TCI and AT&T Broadband. Hey, Scarlett, we get PayPal. That stock is also dropping in post-market. Sees earnings for this year coming in lighter than estimates. They see it coming in $5.10 a share versus $5.49 a share. Remember, they just did some cost cuts and layoffs last year and in January. So this also doesn't really feel that great. However, for the fourth quarter, total payment volume did come in better than estimates, but it's that outlook that's coming up short.
Yeah, also some news on the return of cash to shareholders. It sees fiscal year 24 share repurchase of at least $5 billion. We'll keep you posted on further developments. In the meantime, Roblox ramps up its in-game advertising. The immersive gaming platform that is the bane of many parents' existence saw a boost in bookings last quarter, thanks in large part to the rollout of ads. We're going to get more insight from Ann Hand, CEO of Super League Enterprise. This is The Close on Bloomberg.
Advertising, very key for driving user engagement on digital platforms, and it's trending upward in gaming. It's expected to reach a market size of $56 billion this year. The rollout of ads on platforms like Roblox is what propelled bookings per daily active user to beat street expectations in the fourth quarter. Let's get more perspective now from Ann Hand, CEO of Super League Enterprise. SLE builds and operates monetization tools used across the gaming market. My daughter finally got into Roblox. She's 9. She does her warrior cats on Roblox. What does this kind of platform look like? How can they make more money, say, in the next 2-3 years?
Yeah, I mean, first of all, it's a beautiful social platform where dynamic content and social connections come together. That's really what's magical about it and how it's different than traditional video gaming as we know it. I mean, look, Super League stock benefits from this great news. I mean, they're up 10% since announcing their earnings. They're trading 10x their revenues. Right now, the average Roblox user spends about 156 minutes a day. The next closest social platform is TikTok with about 95 minutes a day. So when Roblox says that they are going to build to 1 billion daily active users, that's their goal. They are, in our opinion, a sleeping giant.
156 minutes a day, that fills me with fear as a parent. And I got to ask you, what about the possibility of not doing advertising but paying a premium for just access to Roblox, kind of like what Netflix does without ads and then just having the free service with ads?
Yeah, I mean, the thing you've got to also realize is that right now the advertising budgets are just a drop in the bucket. That's why I say it's a sleeping giant once they really start to turn that engine on. We're one of their strategic reselling partners in that space. The beautiful thing that they do with their advertising model is it's embedded into the game experience itself. So it's not traditional digital advertising the way we know it with banner ads and pop-ups and things that disrupt the experience. You know, I've talked to you guys before about recreating Barbie's dream house in the metaverse. We do kinds of neat things with Maybelline and Visa where you can try on different looks. And so these are really about true product placement that is overall enhancing to the user. So we think that this is something that the user enjoys. And again, it's their free will too. It's very different advertising. They choose to go into that experience and engage. And so it's not jumping in front of them in the game experience.
So Alex, going back to your idea of investing in your face.
I would totally do that. Now you got my attention, Ann. Okay. Now I get it. In terms of using AI, what's the best route here? Developing your own AI or using OpenAI?
Yeah, I do think we're the beneficiaries of AI. I know some, right now with Google kind of taking a bit of a hit, they're maybe one of the victims of it and its issues and how it could challenge search. But For us, we're using a lot of open tools that are readily available to accelerate development, to enhance experiences. You can do better targeting, better performance measurement and insights. So for us, it's an accelerant.
Okay, got it. That's on the AI front. What about Apple and all the push from regulators to lower its App Store fees or at least give people a way around it? If there's movement on that front, what does that mean for Roblox? What does that mean for you?
Well, the beauty of Roblox is that while, it is a walled garden, so to speak, it is a co-creation platform. And so anybody can make a Roblox experience, anybody can make a game and participate in the economy. And so they fundamentally designed this to be open source. And so what you have now is other walled gardens trying to follow in that suit and make sure that they're creator friendly. You've got people making some of the biggest Roblox mini games in the world, and they're multimillionaires. And you're talking about 1, 2, 5, 10 people shops. So we're not talking about the Activisions and Take-Twos that can now be a successful game publisher.
All right, Anne, really appreciate your joining us. Anne Hand is CEO of Super League Enterprise. We're not done yet here on The Close. We're going to get insight on supply chains and the economy from the CEO of shipper XPO, which was out with the results earlier today. The stock at a record high. This is The Close on Bloomberg.
Welcome back to The Close. I'm Alex Steele with Scarlett Fu. Another shares of companies that we're watching is XPO. Stock hit a all-time high today. Look at that gap higher as we saw earnings. So it's a less than truckload company, so you can basically ship across the country kind of smaller loads. It posted a sales and profit that came in above analyst estimates. Adjusted earnings per share in the fourth quarter were 70 cents, well above the 62 cents analyst expected. Joining us now for an exclusive interview is Mario Herrick, the CEO of XPO. Mario, if I'm an economist and I'm looking at your numbers, what did I learn about the economy today?
Well, when you look at the economy overall, it's still a soft freight environment, what we're seeing out there. However, we are seeing some green shoots. When we look through the fourth quarter, we have seen the trough earlier in the quarter in terms of freight demand. We've seen that accelerate through December, and January got better than December as well. So we're seeing some improvement in the economy, but overall, it's still a very soft freight environment.
It's still an overall soft freight environment, yet you look at your numbers, they did really well. Your competitor, Saia, also hit a record high. So these less than truckload carriers are generally doing well, even with the mixed signals from the economy. Why are full truckload carriers still seeing some weak demand and rates? Why that difference?
Well, there's a bit of a difference between the less than truckload industry and the truckload industry from the perspective of available capacity. In the less than truckload industry, you have a handful of carriers with a deep competitive moat, so it's hard to get in that business. So what ends up happening, it becomes less cyclical when there's a soft economy. Now, for us specifically, we have a great strategy, and it's working. We have the right team behind it. We're executing. We're growing margins. We're growing profits.
Yeah.
And importantly, we're improving our service product for the customers.
Well, talking about that, you had double-digit core pricing increases. I'm sure a lot of companies would be very envious of that. How much more can you get? Or have you maxed out on your price increases?
So I think over time, we have a few levers for that. One is around offering new services for our customers. And when we offer those services, they come at a higher premium price. For example, when you do a retail store launch or a rollout, that comes at a premium because you're offering an extra service. But also, the service quality that we are offering our customers in terms of picking up on time, delivering damage-free, is a company record. And that earns you a higher price from the customer who doesn't want to see disruption in their supply chains.
They don't want to see disruption in their supply chain, but there's a point at which they might start to push back against price increases. Are you seeing evidence of that?
Currently, based on where we are in the less than truckload market, we do expect pricing to be up in the mid to high single-digit range, given all the dynamics that we see in the industry, where you have a limited amount of capacity, you have higher demand. When you look at our shipment count in the quarter, it was up 6% on a year-on-year basis. So we're still seeing a very healthy environment for pricing in the less than truckload business.
That feels like a yes. That feels like you could take more price if you wanted to.
Yeah, I mean, from our perspective, our goal is to provide great service for the customer, but also at a fair price, given that we see a lot of cost inflation in our business as well.
Talking about cost inflation, what about on your own cost side? Are you still seeing inflation? Are you seeing any disinflation?
We're still seeing cost inflation, and the way we look at it, one is wages. It's typically in the mid-single digit, call it 4 to 5% increases on a year-over-year basis. So we see cost inflation being in the, call it 5 to 6% range, and our pricing is in the high single-digit, low double-digit range, which is outpacing the pace of cost inflation.
Is it hard to find talent, to find workers, to find staff? I mean, I know that there's been some movement in the industry. You had the liquidation of Yellow, for instance. How does that change things up in terms of your ability to attract and to retain workers?
Well, first, we have seen a easier to hire into labor market. When you look at the fourth quarter specifically, our applicants per rec are up more than 100% on a year-on-year basis. But importantly, we provide great benefits for our drivers and dock workers. And when you think of our drivers in less than truckload, they get to sleep in their own bed every single night. So it's an industry where we have much higher retention. And we also run our own driver schools. We can graduate up to 2,000 drivers per year where we pay for the tuition. And it's a great career development program for our employees.
And you're seeing like real pickup, like people want to be hired by you for these kind of jobs, because I feel like in the pandemic, you just could not get the workers for these jobs.
Yeah, we have seen it in the less than truckload industry, again, because the drivers get to sleep in their own bed every single day. And that makes a big difference. And also our benefits program is fantastic for our drivers and dock workers and all of our workers across the company. And you couple that with wage increases, you couple that with good benefits and good also working hours, that leads to obviously an uptake and an easier labor market for us to hire into.
I mentioned Yellow and how it liquidated. It went into bankruptcy, and of course, their assets were sold off. And you purchased 28 warehouse service centers from Yellow. Tell us how you plan to integrate that into your overall business and when you can start to see that show up in a material way in your earnings.
Yeah, so we are planning on launching these service centers over the next 12 to 18 months, roughly, and they start going live in the month of April. And these are a massive acquisition for us. You can't find those type of assets that are close to highways, to big interstates, where we can leverage that to make our network more efficient, and it helps us improve our service product for the customer and then give them the capacity when they need it.
So you're talking a really good talk with what you guys are experiencing. You did mention them at the beginning that the economy is still a little soft, like it's not super, super strong. Do you anticipate an acceleration? Are you seeing any signs of that? Are you anticipating sort of a trough? How do you see the economy evolving from where you sit?
It's tough to call the macro. There's a lot of mixed signals based on what we're seeing. Now, we do survey our customers on a quarterly basis. And in the last surveys we have done, what we've heard from our customers, about 2/3 of our customers expect the first half of the year to see roughly flat demand. And the majority of the customers expect to see a pickup in the back half of the year. So there is some cautious optimism.
Are those customers retail? Are they, like, what are those? What's the end demand?
2/3 of our customers are industrial companies and 1/3 are retail companies. And the cautious optimism for the back half comes from both the industrial side and the retail side.
You mentioned costs earlier and how wages were a big part of that. What about fuel costs? I mean, oil prices, Alex, have come down a lot.
Ish.
Well, certainly gas prices, right? Gas prices have definitely come down quite a bit. But how are you thinking about what's going to happen with fuel costs as we get to an environment where the Federal Reserve will start cutting rates and risky assets will start moving higher, and that would potentially move oil prices and gas prices higher too?
Well, the way it works in our industry is that what you charge the customer has a fuel component that is pegged to what the fuel prices are doing, what the diesel prices are doing. So effectively, it's a pass-through to the customer. Obviously, if the rates of diesel are higher, the customer is going to pay a higher fuel surcharge to offset the incremental cost. But if it's lower, the customer will pay an overall lower cost to being offset by the fact that
So you don't have that exposure to fluctuating gas prices?
That's correct. We usually, I mean, there is a flow-through on that revenue. So you would see it in the revenue line, but effectively it's a way to mitigate the risk of fuel prices going up or down.
Very clever. Just passing it on entirely. Mario Herrick, thank you so much for joining us today. Mario is CEO of XPO, as we mentioned, a trucking company, logistics company. Stock doing very well today.
I do find that really interesting, though, sort of that macro read, that it's hard to call, that the 2/3 of this year is going to be a little dicey, not that great, but then both retail and industrial customers looking for an uptick in the back half.
Yeah.
I think that really interesting and sort of tracks with kind of Fed cutting sort of midway through the year.
We don't know a lot about what's going to happen between now and the middle of the year, but a lot of good things is going to happen in the second half of the year. I think that's the message from so many different corners, right?
Right. I guess that's true. There's an election. That could be great.
Well, that could throw everything upside down.
I'm kidding.
Let's take a look at how markets closed on the day. You had the S&P 500 not yet at 5,000, but getting close, within 5 points of that level. Not a whole lot of movement in the bond market, Alex, even with that mammoth 10-year auction.
I know. What a bummer. I was really expecting some fireworks there, but the takedown was good. The bid to cover was good. It wasn't all about primary dealers. It was solid.
It was kind of a yawner in the end. The dollar not doing much of anything today, unchanged, but look at that. Oil prices, there's your oil prices moving higher.
I mean, fair enough. I mean, it's up by 1%. It's really hard to get a read on the oil market, to be perfectly honest.
It feels
perplexing
like
everybody.
It's divorced from all the geopolitical tensions.
Totally. Want to know why? Because U.S. shale producers, although U.S. big guys, Chevron and Exxon, just look at their quarter on Friday. I mean, the enormous amount of oil coming out of the Permian.
The core producer now at this point.
Exactly.
All right, coming up, the top three, where we focus in on the top three movers and shakers of the day's biggest stories. This is The Close on Bloomberg. It is time now for the top three. Every day at this time, we take a deep dive into the people at the center of the day's top stories. And up first, this will be a familiar one, Leo Messi, the soccer superstar, enraging fans in China yet again after he took part in a match in Japan. And this comes just days after sitting out a match in Hong Kong. Chinese fans were outraged. They saw it as an even greater show of disrespect. Now, Alex, Messi had sat out of the Hong Kong game because of an injury, but then he said he felt good enough to play in Tokyo.
So what do we think is going on here?
Well, I mean, it depends if you're a conspiracy theorist, but people in China are pretty upset, and they're saying, oh, this indicates that you don't want to play in China, you don't care about our fans. I mean, bottom line, the depths of animosity between China and Japan run really deep, and people are liable to overinterpret things.
I mean, he just also could have been injured, no?
Yeah,
but maybe
I think
this is a super naive way of looking at this.
I think that's fair, but, everyone has a theory, and Leo's probably thinking, I just wanted to rest.
Yeah, fair enough. I mean, I like resting. Okay, let's go to stay in China for just a moment. So Wu Qing is China's newly appointed top markets regulator. He's a banking and regulation veteran who earned the reputation as, quote, the broker butcher. Oh, it sounds weird. When he cracked down on traders in the mid-2000s. And this is pretty significant because they replaced the head of its securities regulator, right? Mm-hmm. And it's all to try and help Xi Jinping do something about the market slide that we've seen within Chinese equities. And what we learned over the last couple days is that if you do something or even think about it or say that you're thinking about it or report about it, people will buy the stocks. Like money
Kind of like a rate cut?
Kind of like a rate cut. Markets want to buy this. Investors want to buy Chinese equities. They just have to see some more stability, I think, or some friendly market regulation.
You had me at the broker butcher. I mean, that kind of nickname gets your attention, right? Beijing is pretty desperate to end this market sell-off, as you put it. And it's interpreted as a pretty strong message from the people at the top, Xi Jinping, his cohorts, his team, really, that they care about what's going on in the stock market and, they've got you.
Because it's confidence, people feel better, and they go out and buy stuff. Like that's sort of, stock market's not the economy, but that's sort of the trickle down.
Yes.
It just shows like there is appetite if they just do it right.
Yes, and maybe Wu Qing is going to be the person that kind of sends that signal. All right, finally, let's move back here to the U.S. Nikki Haley losing the Nevada primary to the option called none of these candidates. Now, this vote was largely symbolic, but it represents a latest blow to her long shot challenge to Donald Trump for the nomination. This primary awards no delegates, but it's not a good headline.
It's just like from a PR perspective, from what President Biden and President Trump are going to say, it's just going to look bad. The late night comics are going to have a field day.
Oh, totally.
I mean, it's all about the spin, right?
It's all about the spin, about the momentum. Let's talk about this a little bit more with an expert, someone who watches this all the time, Julie Fine of Bloomberg. Julie, what does it mean here that Nikki Haley did so poorly in Nevada? I know that, there was no primaries awarded in this, no delegates awarded in this primary, but it, again, is not a good look. And it's something that the talking heads are going to go on and on about.
All right, you both hit it on the head. It's the headline. I mean, really, it doesn't mean anything because she wasn't going to get any delegates here anyway. I mean, they had made the decision, her campaign already saying they felt this was rigged for the former president. With the caucus, they made the decision not to do this. They didn't have it didn't appear that they had anybody on the ground there. I was there last week actually doing some stories ahead of this primary, so it didn't appear they had a big campaign operation there, but it's the headline. If you lose to essentially none of these candidates, I mean, it's not a good look. They will spin it this way. Luckily for her, as you know, the news cycle moves pretty quickly, but this was not something that obviously. I would imagine any campaign would want to happen. But again, I think you have to look forward. This is the election week here. You have this primary and the caucus, confusing voters as it is in the first place. But at the end of the day, all the delegates will likely go to the former president.
And that kind of drumbeats us to South Carolina. Julie, what's the narrative as we head there?
Well, I mean, listen, this is her home state. She obviously needs to do well there. I think there have been expectations that she will not win it, but she wants to have a good showing. You want to do well in your home state before you head into Super Tuesday when so many states vote. And, you know, she's well behind. So it'll be interesting to see. One thing, though, her campaign keeps discussing, they continue to raise money. So she has money to move forward. It's just a question if she has the numbers.
Okay, she has the money to move forward, may not have the numbers, but how much longer do her very, very deep-pocketed supporters, like the Kochs, continue to fund her campaign when she's not getting anywhere here?
Well, I think they will make that decision likely after Super Tuesday. I mean, I cannot speak for them, but I think Super Tuesday is such a big day with so many states involved, and they will want to see how she does in her home state of South Carolina.
Yeah, you know, Julie, what's the talk of the third-party candidate with Nikki Haley?
I mean, we've been hearing all about no labels for some time now. They don't have anybody out yet. I mean, the conversation is still there every time I see an interview, like with someone like Chris Christie. They're asked about this. However, they don't have a candidate. So right now, it is the two of them essentially going for that Republican nomination. And it will be interesting to see if you hear a little bit more about no labels following Super Tuesday.
You know, Joe Biden did well in the Nevada primary, which awards no delegates. But what's the word out of his campaign? You know, they've been fairly quiet because he's the presumptive nominee. But surely they're starting to spin things and, you know, coming out with a message.
Absolutely, but they've been quiet because they can be. I mean, he's dealing with stuff, obviously, as you know, on Capitol Hill as well, but he doesn't have to deal with this back and forth during a primary. So I think that campaign, you will see them becoming more and more active in the weeks to come, especially when you look at what's happening on Capitol Hill. I mean, I'm sure at some point you're going to hear from them, hey, we wanted to do something about immigration and this bill was killed. I would expect that to be part of the message moving forward.
Got it. Yeah. Bloomberg's Julie Fine, Bloomberg's Dallas bureau chief and longtime observer of all things political. Really appreciate your joining us there. And of course, Julie was just in Nevada not so long ago reporting ahead of the primary taking place there. There was a lot of breaking news today, this hour, and we continue to get some, Alex, especially from Disney, because, and as a mom of a daughter, Disney is going to release Moana 2 in theaters, yay, in late 2024.
This is very exciting. I mean, she's 9 and she's into Taylor Swift. We're out of the princess, but I think Moana straddles the princess sphere. Like, she's not a traditional princess, no pretty dresses, so I think we're good with that.
Wait, so she's into Taylor. I've got Taylor news for you as well.
Yes, Taylor news.
Disney Plus is going to premiere Taylor Swift concert, the Eras Tour concert, film next month on its streaming service. You are a Disney Plus subscriber, right?
Of course.
You have to be.
I mean, not for her, but for me, because of all the Marvel stuff. But yeah, well, but even if we weren't, we'd probably have to get it for that.
Yeah.
That's the thing.
Apparently, there are going to be new songs in this movie that they're going to release on Disney Plus. So.
And there you go. And the stock is up still about 7.5% after those losses in the streaming just were crunched. They're still losing though, but just a lot less. So less bad is good, I think, is what
less
we can take away
bad
from
is
this.
good, yes, especially when it comes to streaming where it's been bad for a while. Yes, they were building up numbers, but you know, the bottom line has been coming through. All right, still ahead, what investors need to watch for tomorrow. It is going to be what, Thursday tomorrow?
Is it? I don't know.
Yeah, today's
like a really long week.
Tomorrow's Thursday. This is The Close on Bloomberg. The Fed just auctioned off a record $42 billion of 10-year Treasury notes and will be selling $25 billion of 30-year notes tomorrow. So let's bring in Ira Jersey, Chief U.S. Rates Strategist at Bloomberg Intelligence. Ira joins us now from Princeton. So demand was not an issue today. What does it look like for the longest duration, 30 years?
Yeah, so tomorrow will be the real duration test, right? So today's auction was very good, like you mentioned. I think, tomorrow could be a little bit more challenged. What we've seen is one auction in a sector doing reasonably well, and then the other auction maybe not doing as well. You saw that just even 2 weeks ago when we had the 5-year auction, which was pretty bad, and then 7-year auction, which went okay. This week, maybe we'll have the reverse, where people are just saying, oh, I want to buy the 10-year, and then maybe they'll avoid the 30-year because of some of the uncertainty uncertainty about what's going to happen with next week's reports, and maybe they don't want to get so long the market right before some important data.
So who's buying? I was mentioning earlier that the primary dealers, they didn't have to show up in droves like they might have at the end of last year. So who's in there right now?
Yeah, so the big one are asset managers continue to buy pretty large. Unfortunately, we don't get all the detail for another 10 days or so before we find out if it was foreigners or domestic funds or banks. What happened at the November refunding, and the November refunding was pretty decent as well. That's the same auction where you have bonds that are maturing and then they issue then new bonds to repay them. Foreigners really came in big in November, so it'll be interesting to see. I wouldn't be surprised if we saw a reasonably big foreign bid for the 10-year today.
So as we head into the 30-year tomorrow, and we have the 10-year today, are we at fair value? Where are we here?
Yeah, we're reasonably close. Looking at my terminal here, 411, 406 is where we have fair value. So 5 basis points one way or the other probably doesn't mean that much. It's kind of noise. I still think that we'll probably rally somewhat this year. The Federal Reserve is probably going to cut rates, maybe not as aggressively as the market's still pricing, but nonetheless, once the Fed starts to cut rates, the long end of the curve usually follows at least a bit. So you could see 10-year yields below 4%. I think by the end of the year will not be that difficult to do.
Yeah, once upon a time, 5 basis points was a big deal. Not anymore.
Oh my gosh, no. We're like, if it's not 20, forget it.
Right.
I mean, please.
Ira, thank you so much. Ira Jersey of Bloomberg Intelligence with a preview of tomorrow's Treasury auction. So let's look ahead to what else we're watching tomorrow. Overnight, you have the Reserve Bank of India coming out with its rate decision. It's going to be a 6th straight meeting where they keep rates unchanged. Moving on.
But just to watch, you got the dollar rupee. It looks like we're in a death cross when it comes to the chart.
Ooh,
so,
and
that could be a dollar story too, but just, pay attention to that. All right, then next up, is it me or is it you?
No,
do them
you go.
all? I go? Okay.
Yeah.
So at 8:30, Tom Barkin will be interviewed by our own Michael McKee, an exclusive interview. I'm just guessing it's going to be wait on cuts, wait on cuts, wait on cuts.
Yeah, they've been pretty consistent of lately, the Fed speak. Not in any rush. March is kind of off the table. Look for more of that. And if he doesn't say that, that'll be truly breaking news. Janet Yellen will be speaking before the Senate Banking Committee, another testimony at 10 a.m. So watch for that. 9 a.m. We'll be covering that.
We'll be covering that. And then at 10 a.m., you get the U.S. Supreme Court will hear a case to decide whether Donald Trump is eligible to run for president. We also have the immunity appeal that is coming down. Will that get kicked up to the Supreme Court? Will, in essence, the Supreme Court have to decide an election in theory yet again? Will they take it up or will they not?
Big questions here that determine what's going to happen in November. And then, of course, earnings season not over, not by a long shot before the bell. Spirit, which is no longer merging with JetBlue, but says that it's still looking into it because the DOJ got in the way, will be reporting Warner Music Group as well, some other consumer names.
Under Armour, Duke Energy, I'll be speaking with the CEO, Lynn Good, tomorrow. You got Philip Morris, Ralph Lauren, Cloudflare, you got Lionsgate after the bell, Expedia, love looking at that one. They should be crushing it even if the economy slows, because you're going to have to trade down or trade up. Also, the personalized choice. Apparently, on Priceline, you can go and decide if you want to fly a Boeing.
Really?
Yeah.
They've added that as an option?
Yeah.
Oh, my
so
gosh.
they're quick to add those things, and that adds a lot for in those kind of circumstances.
That just complicates the whole effort of buying plane tickets.
Yeah, but don't you I get into it? I could spend days just down the rabbit hole of finding the right deal at the right time and the right plane. No, or is that not where you are?
No. Yes, but it's stressful, so it fills me with anxiety.
Oh, I love it. I have to check
you
things off
can book
the
my
list.
tickets next time.
Okay.
All right.
It'll be so fun.
That does it for Bloomberg Markets, the close. Balance of Power's up next with Kaylee and Joe. They'll be in D.C. They'll take you through what else is happening in Washington. This is the close on Bloomberg. Have a great evening.